The indicators are screaming. Margin debt at $1.21 trillion, the highest in history. The Buffett indicator at 185% of GDP. Commercial real estate defaults accelerating. Regional banks failing, consumer credit deteriorating. The yield curve has inverted and normalized. Every signal that preceded the 1929 crash, the 2000 dot-com collapse, and the 2008 financial crisis is flashing red right now. Yet the S&P 500 keeps hitting new highs. The market seems immune to gravity. Investors keep buying, prices keep rising. The crash that every indicator predicts simply hasn't happened. Why? The answer isn't that the indicators are wrong. The answer is that there are three mechanisms currently propping up the market, preventing the natural correction that should have already occurred. And all three mechanisms are artificial, temporary. And when they finally exhaust themselves, the crash will be more severe precisely because it's been delayed. Let me show you exactly what's holding this market up, why banks and institutions don't want you to understand it, and what happens when these supports inevitably fail. Mechanism 1, the buyback machine. In 2024, S&P 500 companies spent $942.5 billion buying back their own stock, setting an all-time record. Goldman Sachs projects total buybacks will reach $1.2 trillion in 2025, potentially hitting $1.3 trillion in announced programs. This isn't normal corporate behavior. This is the primary mechanism preventing market collapse. And it's accelerating precisely when economic fundamentals are weakening. Here's how the buyback machine works. When companies repurchase their own shares, they create artificial demand. They're not buying because the stock is undervalued. They're buying to reduce share count, boost earnings per share, and support stock prices. It's financial engineering, not investment. Apple announced a $110 billion buyback program in 2024, then another $100 billion in May 2025. That's $210 billion in announced buybacks from a single company. Alphabet authorized $70 billion. Meta expanded its program by $50 billion and spent $17.6 billion in Q1 2025 alone, and Nvidia announced $60 billion. The scale is staggering. In Q1 2025, companies spent $293.5 billion on buybacks, a new quarterly record. That's nearly $100 billion per month in pure demand for stocks coming from corporations themselves. This creates a floor under the market. Every time prices start to fall, buyback programs kick in. Companies buy the dip, not because they believe in value, because their boards have authorized programs and CFOs must execute them. It's mechanical, automatic, relentless. But here's what banks don't want you to understand. These buybacks are being funded increasingly with debt, not cash flow. Companies are borrowing to buy back stock while their business fundamentals are weakening. They're leveraging their balance sheets to support stock prices. Big Tech's combined AI capital spending is projected to reach $405 billion in 2025, with estimates of about $1.15 trillion from 2025 to 2027, much of it debt financed. These same companies are simultaneously running massive buyback programs. They're borrowing to spend on AI infrastructure that may not generate returns, while also borrowing to buy back stock. This is leverage on leverage. The companies are loading up debt. Investors are using margin debt to buy these leveraged companies. And the buybacks create the appearance of demand that justifies more leverage. The buyback boom started accelerating precisely when the Federal Reserve began cutting rates. With the Federal Reserve cutting interest rates, buyback activity is likely to pick up. And analysts predict the total to reach $925 billion in 2024, surpassing the 2022 record, and moving on to cross the $1 trillion mark in 2025. Why? Because when rates fall, holding cash becomes less attractive. Companies that were earning 5% on cash balances now earn less. So they deploy that cash through buybacks. But this creates fragility. If economic conditions deteriorate and companies need that cash for operations, they won't have it. They spent it buying stock at all-time highs. Moreover, buybacks artificially inflate earnings per share. When a company initiates a buyback, they reduce the number of shares on the open market, which can increase the value for continuing shareholders as the same earnings pie is cut into fewer slices. But the earnings themselves haven't grown. It's accounting manipulation that makes the company appear more profitable. When recession hits, these buybacks will stop instantly. Companies facing revenue declines and cash flow pressure will suspend programs. The $1.2 trillion in annual buyback demand will vanish. And when it does, who will buy stocks? Retail investors are already maxed out with margin debt. Institutions are reducing exposure. The buyback machine is the marginal buyer keeping prices elevated. When it stops, there's nothing underneath. Mechanism 2, Federal Reserve liquidity operations. The second mechanism is less visible but equally powerful. The Federal Reserve is providing liquidity support to the financial system through repo operations and the standing repo facility. This isn't quantitative easing, it's emergency backstop lending that's become permanent. The standing repo facility, established in 2021, allows primary dealers and select banks to borrow against Treasury and agency securities. The aggregate operation limit is $500 billion and a minimum bid rate of 4.5%. This facility provides a safety valve. When market stress appears, institutions can tap the Fed for cash instead of selling securities. During periods of stress in September 2019 and March 2020, repo operations spiked dramatically. Upon commencement of operations on September 18, 2019, dealers borrowed around $70 billion, and the amount quickly increased to above $100 billion, peaking at about $200 billion during COVID-19 pandemic pressure, before declining to zero by June 2020. What's critical is that these facilities now exist permanently. In previous cycles, when financial stress appeared, institutions had no choice but to sell assets to raise cash. Those forced sales created downward pressure on all asset prices. The selling cascaded. Now, institutions facing liquidity pressure don't have to sell. They borrow from the Fed. The repo facility absorbs the stress. Markets don't experience the natural liquidations that would otherwise occur, but there's a problem. Overnight reverse repurchase agreements saw a daily take-up averaging around $1 trillion in June 2025, down from a peak of $2.55 trillion in December 2022. This reverse repo facility is where money market funds park cash with the Fed. The decline in reverse repo usage signals that liquidity is draining from the system. Money that was parked safely at the Fed is being withdrawn. Where is it going? Some into private markets, some into speculation, but the overall liquidity picture is tightening despite the Fed's operations. The Fed is simultaneously running quantitative tightening, reducing its balance sheet from $9 trillion to approximately $7.4 trillion. They're draining reserves while providing emergency liquidity through repo operations. These cross-currents create artificial stability, the appearance of calm while underlying stress builds. Banks and institutions know this. They're using Fed facilities to avoid showing stress publicly. Regional banks facing commercial real estate losses can borrow from the Fed instead of acknowledging problems. Hedge funds with leveraged positions gone wrong can access liquidity instead of liquidating. The Fed has essentially built a scaffolding under the market. As long as the scaffolding holds, the market doesn't collapse. But scaffolding isn't foundation, it's temporary support. And it's holding up a structure that should have already fallen. Mechanisms 3, passive flow dominance. The third mechanism is the most insidious because most investors don't realize it's happening. Passive index funds now dominate market structure. They buy automatically, regardless of price, valuation, or economic fundamentals. Every paycheck, millions of workers have 401k contributions automatically invested in index funds. Every month, pension funds rebalance into passive strategies. The buying is mechanical, relentless, and completely disconnected from fundamentals. This creates what's called price-insensitive demand. Traditional active investors buy when they believe stocks are undervalued and sell when they're overvalued. Passive funds buy continuously regardless of valuation. They don't care if the Buffett indicator is at 185%. They don't care if the Shiller-Cape ratio is extreme. They just buy. The shift to passive has accelerated. Over 50% of U.S. equity assets are now in passive strategies. In previous market cycles, this percentage was 20% or less. The dominance of passive creates artificial stability. Prices don't correct because the passive flows overwhelm selling pressure from active investors who recognize overvaluation. But passive strategies have a critical vulnerability. They work wonderfully in rising markets. The buying pressure from constant inflows pushes prices higher, which attracts more inflows, a self-reinforcing cycle. In falling markets, the mechanism reverses. When investors panic and withdraw from 401ks or move to cash, passive funds must sell. They don't have discretion. They can't hold and wait for recovery. They must match redemptions with sales. And because passive funds are so large, their forced selling overwhelms the market. We saw a preview in March 2020. When COVID panic hit, passive funds faced massive redemptions. They had to sell everything indiscriminately to raise cash. The S&P 500 fell 35% in 3 weeks. Not because fundamentals changed that dramatically, because passive flow reversed. Right now, passive flow is positive. 401k. Contributions continue, but these flows are slowing. Recent data suggests a pullback, with buyback executions now trailing typical seasonal levels after elevated repurchases in January and February. And uncertain retail investors averaged a dreadful 40 net bulls reading in the last 4 weeks. When recession hits and unemployment rises, 401k contributions will decline. Some workers will stop contributing to preserve cash. Others will lose jobs and stop contributing involuntarily. Retirees will accelerate withdrawals to fund expenses. The passive flow that's been supporting the market will reverse. And when it reverses, there's no natural buyer. Active investors are already underweight. They recognize the overvaluation. Buybacks will have stopped. The Fed can provide liquidity, but can't force institutions to buy stocks. The passive flow reversal will create a vacuum, selling pressure with no offsetting demand. Why banks don't want you to know. Banks and financial institutions benefit enormously from keeping these mechanisms hidden from public understanding. Here's why. First, banks earn fees from managing buyback programs. When Apple executes a $110 billion buyback, investment banks facilitate those transactions. They earn commissions on every share repurchased. The more buybacks, the more fees. Banks have financial incentive to encourage buybacks even when they weaken corporate balance sheets. Second, banks are counterparties to the Fed's repo operations. When institutions borrow through the standing repo facility, banks are often the intermediaries. They earn spreads on these transactions. The more stress in the system, the more borrowing through Fed facilities, the more banks earn. They profit from the artificial stability while taking no real risk because the Fed is the ultimate lender. Third, banks manage passive index funds. Vanguard, BlackRock, State Street. These institutions collect management fees on trillions in passive assets. The fees are small in percentage terms, but enormous in absolute dollars. They have no incentive to question whether passive dominance creates systemic fragility. They profit from the current structure. Fourth, and most importantly, banks are sitting on large positions that would be crushed if the market corrected naturally. They hold corporate bonds from companies with weak balance sheets. They hold commercial real estate loans. They're exposed to counterparty risk from hedge funds running leverage strategies. If the market crashed today based on fundamentals, banks would face enormous losses. The three mechanisms, buybacks, Fed liquidity, and passive flows, create the appearance of market stability. This appearance allows banks to avoid recognizing losses, to delay raising additional capital, to continue paying dividends and bonuses. They need you to believe the market is healthy, that prices are justified by fundamentals, that everything is fine. Because if enough investors recognize the artificial nature of current support mechanisms, if capital flight began, the system would collapse before banks could position themselves defensively. What happens when support mechanisms fail? These three mechanisms are interconnected and self-reinforcing, but they're also temporary and vulnerable to cascading failure. Let me show you how it will unfold. Stage 1, economic deterioration becomes undeniable. GDP contracts, unemployment rises, corporate earnings miss expectations significantly. The recession that indicators have been predicting arrives. Stage 2, companies suspend buybacks. Facing revenue declines and cash flow pressure, CFOs immediately halt stock repurchase programs. The $1.2 trillion in annual buyback demand vanishes. This happens quickly because buybacks are discretionary. Unlike dividends, which create negative signals when cut, buybacks can be suspended quietly. Stage 3, market starts declining. Without buyback support, natural selling pressure from fundamentals asserts itself. Stocks fall 10%, then 15%. This triggers margin calls for leveraged investors. Forced selling begins. Stage 4, passive flow reverses. As markets fall and recession deepens, 401k contributions slow. Some investors panic and move to cash, triggering redemptions from passive funds. Funds must sell to meet redemptions. The selling drives prices lower. More panic, more redemptions. More selling. Stage 5. Fed liquidity reaches limits. The standing repo facility can provide cash against collateral. But as stock prices fall and corporate bonds lose value, collateral becomes impaired. The Fed can't lend against collateral worth less than the loan amount. The liquidity support hits practical limits. Stage 6. Cascade accelerates. Leverage positions unwind forcibly. Hedge funds face redemptions. Prime brokers cut credit lines. The mechanisms that prevented natural correction intensify the correction once it begins. Prices that should have fallen gradually instead crater rapidly. The three support mechanisms don't just delay the crash, they make it worse. Companies that used buybacks to support stock prices now face weakened balance sheets precisely when they need financial flexibility. The Fed provided liquidity that enabled more leverage, creating more forced liquidations when the cascade begins. Passive dominance means redemptions hit with overwhelming force instead of gradual rebalancing. The historical precedent. We've seen this pattern before. In 2007-2008, similar artificial supports delayed the inevitable. The Federal Reserve provided liquidity through the term auction facility. Banks continued lending to avoid recognizing losses. Rating agencies maintained 8AA ratings on mortgage securities everyone knew were garbage. The supports delayed the crash, but made it more severe. When Lehman Brothers finally failed in September 2008, the cascading losses were catastrophic precisely because they'd been delayed and hidden. If the system had corrected in 2006 when the housing bubble was obvious, the losses would have been smaller. The delay allowed more leverage to build, more fragility to accumulate, more interconnections to form. The same pattern is playing out now. Every month the crash is delayed, more margin debt accumulates. More corporate debt is issued to fund buybacks. More passive flows create price insensitivity. More stress is hidden by Fed liquidity operations. When the supports finally fail, and they will fail, the correction will be more violent than it would have been if allowed to occur naturally a year ago. What you need to understand, the market hasn't crashed yet, not because the indicators are wrong, not because this time is different, not because the economy is actually healthy. The market hasn't crashed because three artificial mechanisms are preventing the natural correction that should have already occurred. These mechanisms are visible if you know where to look. Record buybacks funded with debt. Fed repo operations providing constant backstop liquidity. passive flow dominance creating price-insensitive buying. All three working together to create the appearance of stability. But appearance isn't reality. The fundamentals haven't changed. Margin debt is still at record highs. Valuations are still extreme. Commercial real estate is still defaulting. Consumer credit is still deteriorating. All the indicators that predict crashes are still flashing. The supports are buying time. But they're not fixing problems. They're hiding problems. And problems that are hidden rather than addressed grow worse. When you understand this, several things become clear. First, the current market level doesn't reflect fundamental value. It reflects artificial support. Second, the longer the support continues, the worse the eventual correction will be. Third, the support mechanisms can fail suddenly when stress exceeds their capacity. What you should do, understanding why the market hasn't crashed, gives you a critical advantage. You can't predict the exact moment when support mechanisms will fail, but you can recognize that failure is inevitable and position accordingly. First, reduce exposure to sectors most dependent on artificial support. Technology stocks have the highest buyback concentration. When buybacks stop, these stocks will fall hardest. Financial stocks are most exposed to Fed liquidity operations. When stress exceeds the Fed's capacity to absorb it, financials will be crushed. Second, recognize that passive strategies, while useful in rising markets, are dangerous in falling markets. If you hold index funds, understand that redemptions from other investors will force selling of your holdings regardless of fundamentals. Consider whether you have enough liquidity outside these positions to avoid forced withdrawals during market stress. Third, build cash reserves aggressively. The three support mechanisms are preventing the natural correction that creates buying opportunities. When they fail, quality assets will be available at prices you won't see again for decades, but only if you have cash to deploy. Investors fully invested now will be forced to sell at exactly the wrong time. Fourth, avoid leverage completely. Margin debt is the accelerant that turns corrections into crashes. In a market supported by artificial mechanisms, leverage is suicidal. When support fails, leverage positions will be liquidated forcibly, regardless of the investor's intentions. Fifth, understand the timeline. Support mechanisms don't fail on a schedule, but economic deterioration is accelerating. Corporate earnings are weakening, credit stress is rising. The moment when support mechanisms can no longer hold back, the natural correction is approaching. The uncomfortable. Truth banks and financial institutions don't want you to understand these mechanisms because widespread understanding would undermine them. If enough investors recognize that buybacks are artificially supporting prices, they'd sell before buybacks stop. If they understood that Fed liquidity is masking stress rather than solving it, they'd reduce risk. If they recognized that passive dominance creates fragility, they'd shift to active management. The mechanisms work precisely because most investors don't understand them. The artificial stability feels real. The market keeps rising, which validates the belief that everything is fine. But those who understand what's actually happening can see the fragility, can recognize that the appearance of stability is maintained by temporary supports, can position themselves for what happens when those supports inevitably fail. The market hasn't crashed yet, but it will. The only questions are when the support mechanisms fail and how severe the crash will be when it comes. The longer the supports hold, the more severe the eventual correction. The more leverage that accumulates. The more passive flows reverse. The more corporate balance sheets weaken from debt-funded buybacks. You now understand why the crash hasn't happened yet. You know what's holding this market up. You recognize that these supports are artificial and temporary. The question is what you'll do with this knowledge. Will you join the crowd believing the artificial stability is real? Or will you prepare for what happens when the scaffolding collapses and reveals the weakness it's been hiding? The choice is yours. But understand this. Banks and institutions are preparing. They're building reserves, reducing exposure, positioning defensively. They understand these mechanisms because they're the ones operating them. They know the supports are temporary. The question is whether you'll recognize it before it's too late.